Reality here is that if you have US interest rates remaining elevated, that translates directly into what happens to fixed mortgage rates here in Canada.
Yeah, that was the message coming from Karl Schamotta, Chief Market Strategist at Corpay. Schamotta has been making headlines over the past few weeks, first on Bloomberg, noting that the Bank of Canada may not cut by continual 50 basis points and trying to reignite the housing market. And then this week, noting that the Canadian dollar could fall on the re election of former President Donald Trump. As we'll see today, a lot of uncertainty remains for the Canadian economy going forward, but we will obviously continue to track its development on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. All right, so today I'm joined by Karl Schamotta, Chief Market Analyst at Corpay. Karl, I want to thank you so much for being on the show today.
Thanks very much for having me.
For sure. I do want to dive right into this as you had an interview on Bloomberg last week where you said the Bank of Canada might not be going 50 basis points cut after cut and could return to 25. Could you explain that a little bit for us?
Yeah, so I think right after the bank's last decision, in which it did deliver that 50 basis point cut, market sort of immediately moved to price in very high probabilities of another 50 basis point move at the bank's December meeting. And I think that odds just simply don't support that. If you look at what's happening in the economy, what's happening in sort of that global rates environment, it really seems more like a coin toss to me. It's not really decisive in one direction or the other just yet. And as the bank itself said many times, probably too many times in the press conference, it is going to remain data dependent, right? We have a couple of employment reports, we have some inflation numbers coming in, and of course we have the biggest risk catalyst of them all, the U.S. election happening before that meeting. So I think there is a very strong likelihood that the bank goes from, delivering that sort of outsized rate cut to going back to the trajectory that it had been following from, earlier this year.
And I do want to get to the U.S. election in a few minutes, but focusing on what you just said, I think that's really interesting. And you said this on Bloomberg that the bank is actually data dependent. So you don't think there's some preset path that they want to get to, and they're just looking for reasons to justify it. Like they actually are looking at the data.
That's right. It is funny because I think, as you've seen as well, right, there was a lot of commentary about the idea that they want to get right back to neutral as quickly as possible, and that to some extent is supported by the fact that the Canadian economy is still very weak. That borrowing costs will continue to rise as long as Canadians are still rolling over mortgages, renewing mortgages. That sort of carrying cost burden is going to continue to climb. But at the same time, there are upside risks, right? The fact that consumers are becoming more and more convinced that that the bank is on their side, that the bank is going to cut rates below 3%. That's translating into a recovery in some parts of the economy, most specifically the parts that are interest rate sensitive, right? If you look at the last two, GDP reports, the last two monthly GDP reports, the growth in the Canadian economy has been coming from, the finance and insurance area, the real estate sector, from construction, and from retail, right? And so those are the things that you would expect to start recovering if consumers, adopt the idea that rates are going to go down in the future. And so I do think that there's a reasonable degree of uncertainty around how much consumers recover here, how much they go out again and sort of double down on that housing driven expansion that we've had for the last 3 decades. And as a result, the bank's going to want to move more cautiously. They don't want to, kind of get themselves into a position where they suddenly and abruptly have to reverse themselves and begin hiking rates at some point. I know all of
Right.
that sounds kind of crazy to say right now, given how bearish everyone is and how, the signs in the economy are clearly negative. But when you are a central banker, you think about these things from a risk management perspective first and foremost. You don't try to focus on boosting growth at the expense of all other things.
And on the central bank's thinking, you also said that the bank, if it were to cut by 50 again in December, it risks spooking the real estate market that in fact it's trying to stimulate. Do
That's
you
right.
think that
So
go ahead.
oh, yeah, yeah, that's right. I think there's sort of 2 points there, right? So one is that if you are delivering repeated emergency level cuts, that can hurt investment from businesses and from consumers themselves. It can change how people view the economy. And we're very close to that sort of precipice right now. There's certainly a lot of negativity out there right now about the Canadian economy. But the other big issue is that if the bank is cutting in, big moves like that and sort of inserting unpredictability about what it might do next, what are consumers going to do? What are potential home buyers going to do? They're going to wait it out, right? They're going to wait until firstly on one hand, rates go down far enough that they can borrow and buy something bigger or better. And on the other hand, if you're a home seller, you're going to wait for that eventual boost in activity to show up. And so, in a weird way, if they move too aggressively on the front end, it might actually, precipitate a freeze up in the Canadian housing market. Now, admittedly, the winter months in Canada are not the months in which we tend to see a lot of activity. So perhaps they see the risk of that as relatively low. But I do think they're going to at least consider the possibility when it comes to December's decision time.
Now, when I watch these press conferences, I get the impression that the way they think about the housing market is, well, it might take off and well, it might get worse. They 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 at least paint a picture as though they're somewhat indifferent. But do you think that's the case, or do you think that they're actively targeting the real estate sector when they're considering these rate cuts?
I think that they are actively targeting the real estate sector in the sense that it is a channel for monetary policy to impact the economy, right? And this was really important. If we go back, over many decades, right? It used to be that interest rate changes made by central banks primarily impacted the economy through a business investment channel, right? They tended to lower the cost of borrowing, for example, and boost the level of investment that businesses were doing, increasing hiring and sort of driving other positive effects in the economy. Vice versa, when they were tightening rates, they tended to exert pressure on the business cycle itself. Now, in recent years, given the sort of shall we say top heavy nature of modern economies, they're targeting financial asset prices to a pretty significant degree because the housing market provides the underpinning for Canadian borrowing, right? When the housing market is performing well, then we tend to see a pretty profound expansion in credit, and that expansion in credit tends to drive other positive effects in the economy. So household consumption comes from that. Business investment hinges on that, and we get sort of a self-reinforcing cycle.
Right.
Now, I say all that, but the reality here is that when the bank was tightening policy over the last couple of years, they were also targeting that vector, right? They were looking to exert drag on the Canadian housing market, to exert drag on credit creation, thereby reduce demand in the economy, and create that slowdown that we are now seeing. So it's a matter of calibration, but I do think that the housing market is very much at the center of it.
So they may act aloof, but it's very much a transmission mechanism for monetary policy.
Yeah, I wouldn't say that that they're I think there are certain observers who expect or think that that we've got this group of policymakers that is intent on driving prices higher forever. I would not say that that's the case at all, right? I think the Bank of Canada is really looking to stabilize things. Vice, the reality is that when they look back at the lessons that have been learned over the last decade in terms of how monetary policy was set and what the vulnerabilities in the economy were, it is very clear that by depressing rates heading into the pandemic, they created a vulnerability that we're now paying for, right? The reality is that allowing Canadian home prices to go up at such aggressive paces has led to, firstly, I guess, a detachment of financial asset prices from the real economy, but also has, put the economy in that very vulnerable position by boosting household debt. And so, a very big part of why Canada has underperformed post the pandemic relative to other advanced economies has been centered on where the housing market was and where debt was before the pandemic hit.
Now, while we're talking about monetary policy, and I know that the bank is obviously thinking about real estate, but let's talk about the elephant in the room, which is the election occurring in just a few days from now. I know you've said that if former President Trump is elected, expect some volatility in the immediate term. Looking more further out, though, say medium term, even longer term, what can how could a Trump presidency affect monetary policy here in Canada? What's in it for us?
Yeah, that's it's kind of interesting that you use the elephant in the room metaphor there because I think of the African proverb in which they say that when the elephants fight, the grass gets trampled, and the reality is here that Canada does have a lot at risk here. Firstly, we have the potential for imposition of tariffs. The potential that NAFTA gets rolled back, that we have some sort of rise in tariffs that impacts Canadian exports. That would potentially lower the Bank of Canada's growth expectations through a couple of channels. Firstly by weighing on exports themselves, but also by hitting that business investment side of the economy, which would mean all else being equal, that Canada should maintain lower interest rates than otherwise. However, the other vector that's really sort of fascinating here right now is the second round effects of the policy platform that Trump is proposing, right? So if we see a situation in which he actually follows through on his campaign promises, and I should say that that's also a very big question. But if he does follow through on his campaign promises, then you see a big cut in immigration. You see more fiscal spending, and you see higher inflation and higher interest rates in the U.S. What do all those things tend to do? They tend to tighten global financial conditions. If the U.S. is, running a high pressure economy, that tends to spill over into tighter financial conditions in other countries around the world. And so Canada is one of the most clearly vulnerable to that type of situation. And I think as you've definitely covered in prior episodes, the reality here is that if you have U.S. interest rates remaining elevated, that translates directly into what happens to fixed mortgage rates here in Canada, right? The Bank of Canada certainly influences them, but the reality is that the cost of money is set outside our borders, and so the environment in which Trump appears to want to take the U.S. is an environment in which Canada would have more difficulty accessing global capital and would therefore see those borrowing costs for households continuing to remain quite high. All of which means the Bank of Canada has to act in a more stimulative way. And that's part of why the Canadian dollar is likely to sell off quite dramatically in the immediate aftermath of a Trump victory, potentially next week.
And I'm glad you brought up the Bank of Canada having to compensate for these higher fixed costs. So, and obviously we're talking all in hypotheticals here, but putting this all together, we could be in a situation where the bank is more relying on the short end of the curve, on short borrowing costs to stimulate the economy. But at the same time, we have inflationary pressures from the United States. So is it possible we could see a lot of short-term borrowing that eventually the bank has to raise rates again to deal with that inflation coming from down south?
Yeah, I think so. I think there is a possibility that inflation could go up globally as a sort of consequence of what the new administration might do. And the crazy thing is that we have a very clear cut example of exactly that happening, right? Inflation did rise in all developed countries during the pandemic, but that huge fiscal response in the U.S., which dwarfed basically anything that had ever been done before, even in wartime, that drove demand up within the U.S. economy. That sucked in demand from other parts of the world and drove prices up. I don't expect, of course, anything on par with that, but all else being equal, that higher inflation backdrop south of the border does mean that prices are higher here in Canada, and so yeah, the Bank of Canada then has a very complex set of objectives and sort of issues to balance as it's setting policy.
That's a real rock and a hard place,
Yes.
to a certain extent. Yeah, yeah. Um, and on the last question, because I know your time's limited, on the U.S. fiscal side, right now they're running deficits of 6%, emergency level deficits. We know that deficits, most people would agree, equal inflation. Does it really? Are we going to see inflation coming out of the U.S. regardless of if Trump's elected? Is this not just a Republican Democrat thing? Maybe worse with Trump, but this is a long-term problem anyway.
Yeah, it's funny that you should say that because I consider myself a fiscal conservative, and I'm like an endangered breed, especially when it comes to the U.S. Right? There's just no one on either end of the spectrum right now who is thinking about sort of fiscal prudence, right? I would not suggest, however, that it necessarily means that we have higher inflation.
Okay.
There is also the possibility that they keep borrowing relatively high, but that the net impulse for the economy is not all that substantial. What U.S. borrowing could do, however, is crowd out private, investment and the availability of capital. So, the more that the U.S. borrows, the more that the U.S. Plans to continue borrowing, the higher background interest rates are going to be. And this comes amid a global dynamic in which the availability of money is beginning to fall, right? So baby boomers are retiring; they're beginning to draw down on their savings. Emerging markets are not recycling their surpluses into the U.S. to the same degree that they were. And basically, the private sector, private investors in particular, are being asked to pick up the slack. So they're buying the majority of I shouldn't say the majority, but the bulk of new treasury issuance, right? And so if we have that environment in which fiscal deficits are expected to remain wide for a very long time, those interest rates are likely to climb, regardless of whether we think inflation is going to remain all that high in the long run. All of which is to say that that makes life difficult for the huge chunk of the economy that has been built up over the last couple of decades, which is basically reliant on cheap money, right? A big chunk of the Canadian economy is reliant on cheap money. And in the US, although it doesn't look like it right now, there still is a huge chunk of the economy that is dependent on cheap money. So end of the day, you could be looking at an environment in which, despite everyone's forecasts right now, that the U.S. economy slows under a Trump administration, and certainly that it continues to slow under a Harris administration. So, yeah, long story short, I'm not quite as worried about inflation as others are, but I am more worried about a deceleration in economic growth that spills over into Canada at some point.
Let's look forward to. Yes.
Yeah, that was a very optimistic outlook, right?
Yes.
Yeah, but I do think there are positive things happening right now. Technological change is advancing and accelerating right now. And I think that's the one key thing that I would sort of point out is that we can all be bearers. We can all be, very worried about current fundamentals. But the reality is, going back through human history, that technology is the underpinning of the economy. That's what really drives us forward. And so there's very little sign right now of a stagnation on that side of things. If anything, we're speeding up. And that means in the very long run that these fiscal deficits, overall debt loads, and other challenges in society can largely be resolved.
That's actually something to look forward to. All right, I could talk to you all day. Carl, thank you so much for being on the show today. That was a great wealth of knowledge for my viewers, and I really appreciate it.
Thank you very much for having me. It was great talking with you.